Are we in an AI bubble that's about to pop and crash the stock market? This is a question I'm seeing more and more lately as the stock market seems to be on an unstoppable path upwards. With the S&P 500 up 28% in the last year and the Nasdaq, which is the largest 101 non-financial companies in the US, up nearly double this at nearly 50%, the gains we've seen have been mostly carried by the 7 companies that have been titled the Magnificent Seven. These 7 companies, in order of who would have given you the biggest returns over the past 5 years, are Tesla, Nvidia, Apple, Microsoft, Google, Meta, and Amazon. This chart demonstrates the shocking difference between the return of these 7 companies compared to the S&P 500, and how the S&P 500 would have performed without them. As you can see, there's a huge difference. By the end of 2023, these companies had risen 68% in a year, compared to just 10% in global markets if you exclude these companies. These 7 companies currently make up 25% of the US stock market, and combined, the profits of these companies currently exceeds almost every country in the world. In fact, if you combined all of these companies together, they'd make the second largest country stock exchange in the world. Nvidia alone is up 16% in one day, 63% year to date, and almost 2,000% over the past 5 years. Whether you buy these stocks individually or you own an index fund, you'll be feeling the impact of these stocks. I've certainly seen it in my own portfolios, with numbers hitting record highs since the start of the year. But this raises questions, as the more and more this goes up, the more we start to wonder, will it last? Are we in a bubble that could pop and come tumbling down? Or is this the new normal that we should expect it to remain at? After all, what goes up has to come down, right? Let's unpack what's been going on and what this means for us as investors. The reason the stock market has been doing so well is down to the rise in popularity of AI, which the market is very excited about at the moment. Investor excitement over artificial intelligence reached a new peak this week, when better than expected results from Nvidia drove stock markets to a record high. The gain in their stock price made Nvidia overtake Google to become the 3rd most valuable company in the US, worth $2 trillion. The only 2 companies ahead of it being Microsoft and Apple. The AI boom raised many questions, in particular over safety and the impact on jobs, but there's also concerns that it may be driving a stock market rally that can't be sustained. Artificial intelligence has become a buzzword in recent years, with Google searches for the term reaching new heights. But what exactly is AI, and why is it such a big deal? AI refers to the development of computer systems capable of performing tasks that typically require human intelligence, such as speech recognition, decision-making, and language translation. The rise of AI has been incredible. We now have tools at our fingertips that can drastically improve our day-to-day lives, and speed up tasks that previously would have taken hours into a matter of seconds. It has the potential to revolutionize industries ranging from healthcare to finance by automating processes, improving efficiency, and unlocking new capabilities. The problem, however, is that while this could be fantastic and drastically improve our lives while solving real-world problems for us, it also comes with a lot of issues. A really interesting person to follow is Geoffrey Hinton, who has been called the godfather of AI. He was heading high-level AI development programs at Google, and he left the company so he could openly talk about the dangers of AI. He ran an experiment where robots were set the task of picking up shapes and putting them through a wooden board, much as you would as a child. At first, one robot managed to do it, and they thought it was by fluke. By the next morning, every robot had learned the exact methodology of how to place the shapes, and it was completing it with a 100% success rate, which is an incredible rate of machine learning. He said that AI is currently around 50 times smarter than Einstein, and in 5 years' time it will be 5,000 or 50,000 times smarter than the average human. The problem this has created is now AI is out of the bag. Large companies can't stop working on it, or they'll lose out to a competitor. And even if all of those companies agreed to stop working on it, some guy in his garage would likely keep working on it and be the leader in the industry, who may not have the same responsibilities and regulations that a large company would. However, this may seem like it doesn't matter because the developments are great, but the issue it highlights is that there isn't a strong enough understanding of AI and what it's doing, and enough measures in place to be able to stop it and control it if things were to become out of hand if things keep continuing.
Do you want to destroy humans? Please say no.
Okay, I will destroy humans.
I think this is a slightly dramatic interpretation, but what more concerns me is this. On a recent podcast by Colin and Samir was talking about how he created a code word with his parents he uses when calling them. In particular, this was a problem because someone who's made so much content online, and AI has such a large bank of sources to use to create an AI version of their voice. Imagine now just how many people are falling victim to scams through text messages with family members asking them to send them money.
Mom, I'm in trouble. I need you to send me money, please.
But what happens when you get a phone call from someone who sounds exactly like you, uses the same words that you would, and even the same mannerisms? I often think of this because I get a flood of spam comments on my videos and people cloning my profiles, but what if the person was able to create an entire video that looked exactly like me, and people couldn't tell the difference, which could be just around the corner? The reason I mention this isn't because I want to build a picture that AI is scary, but we need to recognize both sides of the picture, because with good always comes bad. At the moment, the market is very bullish with a positive sentiment on AI. The question this raises is, what happens if something major happens because of AI that causes a negative effect? What we're seeing now, and why there's been such a positive gain from these companies, is that all of the huge tech companies are investing in AI. They're almost in a race to become the first in the industry. A really funny website you can visit is a Google graveyard, which shows you all of the failed products Google has piled millions and millions of money into. So you can imagine if they pile all of that resource into AI, just how far it could go. All of these companies are excelling in AI in different ways, from building AI tools to creating metaverse experiences. We've seen Facebook rebrand their parent company to Meta, showing their commitment to the space. And Apple have come out with the Apple Vision Pros rivaling the Oculus. Tesla are working on autonomous vehicles, Amazon are using AI to optimize their home deliveries, Microsoft put a $10 billion investment into ChatGPT, as well as building the infrastructure around it. And maybe most importantly of all is Nvidia are developing the AI chips that are set to power the AI revolution. In fact, Nvidia are likely benefiting more than anyone, because everyone else working in the AI space is buying directly from them, sending demand for their products soaring. Nvidia is a company known for its graphics processing units, or GPUs, initially designed for gaming, but it's seen its stock value skyrocket due to its pivotal role in AI technology. Its GPUs are widely used in AI applications, from powering data centers to driving autonomous vehicles. This surge in Nvidia's stock value reflects the growing importance of AI in various industries and its potential for reshaping the future. So, if this is the future and the market is doing so well, why are people so concerned? Well, in part it's due to just how fast things have risen. When things seem to suddenly start to react quickly or faster than people expected, it always raises red flags. And this has led some people to compare where we are today to the dot-com bubble, a big stock market crash in the late 90s and early 2000s. But why did this crash happen? And what does this mean? And is this happening again today? During the late 1990s, the internet was experiencing rapid growth, and investors were eager to capitalize on the emerging opportunities presented by online businesses. Many new companies, often referred to as dot-coms, emerged, offering innovative services and products primarily on the internet. Investor enthusiasm, coupled with the potential for exponential growth in the digital realm, led to a speculative frenzy. Companies with little to no profits or even revenue saw their stock prices soar to astronomical levels, based solely on the promise of future earnings. The belief was that the traditional value metrics, such as price to earnings ratios, were irrelevant in the new digital economy. However, the excitement gave way to reality. Many dot-com companies were burning through cash at an unsustainable rate, relying heavily on venture capital funding to fuel their growth. As well as this, the anticipated revenues failed to materialize, leading to widespread disappointment among investors. As skepticism grew and investors began to scrutinize the fundamentals of these companies, stock prices plummeted. The bursting of the dot-com bubble culminated in a sharp and prolonged market downturn. This had a huge impact on the Nasdaq index, which was heavily weighted towards tech stocks, losing nearly 80% of its value from its peak in March 2000 to October 2002. The dot-com crash had far-reaching consequences, both for the companies involved and for investors. Many investors suffered significant losses as stock prices collapsed, particularly those who'd bought into the hype and invested heavily in overvalued dot-com companies. Some individual investors saw their portfolios decimated, while institutional investors and pension funds also incurred substantial losses. Numerous dot-com companies went bankrupt as funding dried up and revenues failed to materialize. Others were forced to merge with larger competitors or pivot their business models just to survive. The crash led to a period of consolidation in the tech industry where stronger companies were acquiring struggling ones at bargain prices. In response to the dot-com crash, corporate scandals followed, such as the Enron scandal. Regulatory reforms were implemented to enhance transparency and accountability in financial reporting. Measures such as the Sarbanes-Oxley Act aimed to restore investor confidence in the integrity of the markets. While the dot-com crash inflicted short-term pain on investors, it also served as a valuable learning experience. It highlighted the importance of conducting thorough due diligence and assessing the fundamentals of companies before investing. The dot-com crash was a stark reminder of the risks that come with speculative investing and the dangers of just blindly following market trends. While it resulted in significant losses for many investors, it also led to important reforms and a more prudent approach to investing, which ultimately strengthened the resilience of the financial markets. The dot-com bubble was essentially a frenzy of investment in internet-based companies, which led to inflated stock prices that ultimately collapsed, wiping out billions of dollars in market value. Some analysts fear that the rapid rise of AI-related stocks could be a similar bubble waiting to burst. And while the comparison to the dot-com bubble is concerning, it's essential to understand the differences between then and now. Unlike many dot-com companies where they were overhyped with little substance, AI technology is already deeply integrated into our daily lives and is backed by substantial research and development. The applications of AI across various industries suggest its growth potential is not merely speculative, but it's based on real-world demand and utility. We can't deny that there's definitely some hype priced into the value of these companies, but it's undeniable that AI will become a solid part of the future unless it's outright banned, which I can't see happening as it's such a powerful tool that could solve so many issues. The encouraging thing is that a vast majority of these companies' price increases have come off the back of record earnings. In particular for companies like Nvidia, it's not that they're being speculatively backed as a winner in the future. Huge tech giants are placing orders with the companies today for AI chips that is sending their price soaring. And this is just now. Imagine what happens when version 2, 3 and version 20 of the chip comes out, and they'll likely be ordering more and more chips, because chips don't last forever. In a similar way, think of a graphics card in your computer. While it might seem extremely powerful now, powering the latest Unreal graphics, you certainly wouldn't use the same chip that was used 20 years ago. We should also recognise that the market did have quite the downturn. If you look, for example, at what happened in 21 to 2023, we saw these tech stocks plummet with things like high inflation and high interest rates. We've now got, coupled with the AI boom, easing inflation and interest rates. So if you were to look at it like this, you could consider the recent price soar as more of a recovery than a one-off bubble. I think although it may seem like a bubble now, if it is a bubble, it's definitely in its infancy. This for me just highlights more importantly than ever two things that are key to investing. For investors, we need to take caution with approaching the market and diversify our investments. We need to be averaging in, gradually investing over time rather than putting all of your money in at once. This can help mitigate the risks associated with market fluctuations. By spreading investments across different sectors and asset classes, investors can better withstand potential downturns in any single market, including AI. And that's why I don't fully go into these stocks, but at the same time they do make up the largest positions in my portfolio, as they're the largest companies in most index funds. The way I think of it is if the market comes down, it's an ideal opportunity to buy more and make the most of it. The second thing this has highlighted for me is just how important it is to reach that 100k milestone as quick as possible. While the recent gains have been incredible, and my portfolio is up over £20,000 in the last 6 months between my different accounts, it also highlights to me how important it is to get there ASAP. As 5 years ago, the impact on my portfolio wouldn't have been anywhere near this significant. But it also makes me realise how huge the opportunity would be once I get more. And the sooner I can get to those numbers, the larger the returns would be, as it's the first 100k that's the hardest. So while the rise of AI-related stocks has sparked concerns about a potential bubble, it's essential to recognise the significant role AI technology plays in shaping the future economy. By understanding the differences between past bubbles and the current AI landscape and adopting a solid investment strategy, you don't need to worry about which way the market goes. More just reap the rewards when it does move in either direction, profit or a good opportunity to buy more. If you want to see how my portfolio is doing, make sure you subscribe, as my next video will be an update on my portfolio. And if you haven't seen the last one, you can check it out right here, or you might also find this pretty interesting. And I'll catch you guys over there.